Welcome back to another edition of Facebook Live. Today's topic, as we mentioned on the money yesterday, was whether or not people should convert to a Roth IRA. And I think before I get into that, I have to explain the differences between traditional 401k and IRA plans and a Roth IRA. The difference is in the tax treatment. With a traditional IRA or a 401k, usually the money goes in on a pre-tax basis. So you get a deduction on the money that goes into the account. The money will go tax deferred, and you get taxed on the money when it is withdrawn. With a Roth IRA, it is completely the opposite. The money that goes into the IRA is after tax. It also grows tax deferred, but the difference is all of the money that comes out of a Roth IRA is tax-free. Not only the principal that you already pay tax on, but all the earnings become tax-free as well. So a lot of people come to us this time of year to discuss Roth conversions, and this is a good time of the year to discuss it because most people have an idea at this stage of the year what their tax bracket is going to be like. Are you going to be in a high bracket or a low bracket this year? Some other things you ought to consider is what are the chances that your tax rate will be higher in retirement. You have to look at the tax bracket you're going to be in right now when you're considering doing a Roth conversion, and the tax bracket you plan on being in when you take distributions from that Roth IRA account. Two ways where you might find yourself in a situation where a Roth conversion could make sense is you suddenly find yourself at this time of the year to be in a lower tax bracket. Perhaps you got downsized, you lost a job, and this year is going to be a particularly low tax year for you. Maybe you have your own business, but business was not particularly good this year. If you find yourself in a situation where you're in a low tax bracket, it might make sense to use that to your advantage. Take lemons and make lemonade. Take that low tax bracket that you're in and try to fill up the tax bracket with the appropriate amount of a Roth conversion. For example, if you find yourself where you're only in about a $30,000 or $40,000 income bracket this year, married couples filing jointly can go up to $75,000, $76,000 of taxable income. When you add in their standard deductions and their personal exemptions, they can go up to $96,000 of taxable income. Stay in the 15% bracket. So the strategy is to estimate how much additional income would bring you to the top of the lower income tax bracket, and then convert that amount from a traditional IRA into a Roth IRA. You're going to pay tax on the amount converted just as if you had made a withdrawal from the IRA. However, even if you're under 59.5, there's not a 10% ROI withdrawal penalty. To make this strategy worthwhile, and this is a key caveat, it's very important that the dollars you use to pay the income tax on the converted amount come from a source other than the IRA. It usually does not make sense to do a Roth conversion and then pay the tax out of the account that you just converted. But if you've got the money sitting in a taxable account, in a brokerage account, a mutual fund account, or even in a money market or a very low earning interest account, sometimes it makes sense to use that money, pay the tax on a conversion if you can still stay in a lower bracket. Now you've got a tax-free retirement account over not only your lifetime, your spouse's lifetime, kids' lifetime, grandkids' lifetime. This is not going to impact the taxation of your Social Security, not going to impact your Medicare premiums. A lot of good reasons to do Roth conversions. It's another version of Facebook Live.